Hello investor, in today's video I'll cover the General Motors, as the company is very dedicated, as you can see on their company's filing, that General Motors on its way to an electric futures with the commitments to 30 new global electric vehicles by 2025. And not only that, but they want to go towards the competitive advantage in batteries, software, vehicle integrations, manufacturing and customer experience. So they want to impact building a zero emission free future. So that's, if I the company 8K statements, as you can see, which they have files to SEC. So here it's mentioned very clear, and this is in the news as well, the first point, that the Hummer, they have they can build the fully Hummer, and the production of this Hummer is beginning in the late 2021. So that's what they mentioned. Right now GM is, honestly, when I'm seeing this, when I was reading, it seems like GM is all into the electric vehicles, right? So they are invested huge amount of money. So does it interrupt Tesla growth? For sure, the electronic vehicle is so huge, as you can see here. I mean, the industry is so big, right? So GM announced $2 billion investment in Spring Hill, right? To produce this vehicle, right? And if I go further in this article, in this 8K, in this their filing, they also have surpasses in China the Tesla. So they have launched EV, the mini EV tiny vehicle, which they have, and that's such a big news that it's also covered by the Wall Street Journal, which is not a small newspaper. Tiny GM car zips past Tesla to lead China's electronic vehicle market, right? So that's not a small story. And the second, and also if I continue they have spent $27 billion, and this is, as you can see in the news on CNBC, towards the autonomous cars. So 27 billions, which are through 2025, right? All electronic and autonomous vehicles, which is an increase of $7 billion. When I was looking into their the filing, SEC filing, which I was wondering why they have raised so much amount of capital, and then because they are in the last quarter they have raised around 14 billion dollars, right? And I was saying, oh, so then I found out, okay, so that's a huge investment is going on there. The increase in investment to 30, we have already seen. And yeah, but not only that, in this article I want your attention here, that what they're saying, we want to lead in the space. That's what they are saying. Executive Vice President of Global Product Development, right? Before, and then also they wants to be number one for sure. Now I just want to cover these points, that GM is as our mindset, because if we won't refresh, we think, okay, this is a traditional gasoline company. No, but they are going all in, investing in the infrastructure, building it and getting it ready, so within the 1 year. So that's the quite challenging, right? So we committed to fight for the EV market share until we are number one in North America, right? So they have so they are doing good investment in the batteries as well, right? So which is also, so the new products, right? So in the advancement of the battery, so they are doing pretty good in the batteries, which can say advancement in engineering have been increased the maximum range of batteries from 400 to 450 miles. So maybe they are pretty behind. We should not compete them with Tesla for sure. That's started a long ago, but good thing is there another company, American company, it's coming, and we use their cars, and they have a strong history, and they're going towards join the Tesla as well. So that's way I am thinking, and they're making new progress in the batteries as well, not only just making the cars. New batteries will make electric car cheaper and last longer. This is come in global news, so right? So that's pretty good. So given all that, Now, if I switch my gear towards the comparison of this company to towards comparison of this companies towards the with the Tesla. Okay, so I will compare now, since now we know enough about this company that they are making very good and long term investments. So let's see where it stands right now. It competes with Tesla for sure. The price wise we know it's way behind, and they are starting, but how their fundamentals of the company is doing. So what I have done, I have picked the large cap stocks of the based on the companies. As you can see, these are 35 billion is Ford Motor Companies, and then right now General Motors stand at 60.63 billion dollars, and Tesla for sure it surpasses 610 times pretty much easily of the Tesla. So now the thing is, can GM go 10x? Is this our new 10x stocks, right? Because for sure Tesla might have started around the same, and then people has a lot of trust. So that's why you see even recently when he raised Elon Musk raised the $5 billion, but still the price dropped, but it still come back because that's the trust on Elon Musk, right, by its shareholders. So but as compared to the PE, for sure it looks very cheaper, right? But we cannot just see from the PE perspective. But the good thing is, if anything is smaller, PE smaller and cheaper, this means it has the futures to go towards that directions, right? So if I compare, this one has quite a good data heavy. So let's compare from the return on equity perspective, right? So just ignore maybe on the Ford because it's a negative, right? But if I see from the return on equity perspective, the GM is 7.80, whereas Tesla is only 5% return, right? And even on the return on investment on the Tesla is negative, where on the return on investment on GM is better. The current ratio on the short-term liquidity perspective, both are over 1, so I'll give that good same vote to both of them. But if I see from the debt perspective, Tesla is much winner. It's even less than 1 debt. So it implies that for every $1 of equity, they only have 60 cents or 80 cents of debt, whereas in General Motor is close to $3 or $2 a debt. So close to $2, so which is pretty debt heavy. One of the reason is, as we can see, they have made a lot of investment and build the factory, building the infrastructure. So they are in the beginning of the curve, right, to making the ground stronger to produce those vehicles. But if I see from the from the gross profit margin perspective, Tesla is for sure is a winner. Their cost is lower. They have optimized that. That's good. It's pretty much half of the GM is pretty much only the half. But if we see from the bottom line perspective, that's quite surprisingly. It seems like the Tesla still it's better. GM is doing better, 3%. Or close to 3%, whereas 1% increase in. So although the gross profit margin is lower, but the bottom line is much better. And for sure, I don't want to compare from the yearly what the Tesla price, we all know, but just want to give some highlight here. GM is not bad as well. Look at if 6 months ago, the half year performance is 50%. Right, this traditional stock, even surprisingly, the Ford stock also did better, 40%. So it's not that bad, given the company has been there and doing so. From the price perspective and the margin perspective, the good thing is it's money-making company. It's not losing the company, right? So that's the plus point here. So what next we'll cover, I'll go more deeper into the financial ratio, and then I'll use the two models, the enterprise value model and the net profit model, to compute my own pricing right, and see whether the stock is undervalued or overvalued, and then we'll see which are what next as well, right? So yeah, if you like so far and new to the channel, please give that like button and subscribe if you are new. Then I really appreciate on that one. Okay, the one thing about the GM is it used to pay the dividend, right? As you can see, the consistent dividend of 38 cents per share, right? But since 27th of April, because of this pandemic, they cut the dividend, right? So the dividend is cut, and it makes sense because now the company is not giving the money out and but building the infrastructure. So hopefully I'm not repeated that a lot. Okay, this is a very data heavy slide again, and I'll just quickly go through on the financials. We already see the ratios on the liquidity side pretty good. 10% is the gross profit margin. Good point here is we can see the last 4-year annual ratios is quite consistent on the gross profit margin, whereas also on the profit margin 5, it shows a profit margin 5, the 5% here. And the return on equity is coming around 16% after tax, and 21 to 16%, which is quite phenomenal. Okay, so now let's go to the spreadsheet and without any delay. Okay, so this is my first spreadsheet. Let me go myself on hide. Okay, so I don't want to cut the screen. Okay, so this is the net profit model. So the net profit model, what I'm doing is I'm taking the last 10 year of data, and then I'm projecting what is my my future growth is, and then using that I'll still use the 10% discount rate. Yeah, I'll just increase the little bit. Okay, so as you can see here, the earning per share, it's grows and pretty much double since 2010 to now estimated 2020 year ending, right? So the growth on the revenue, it's quite negative in the last 2 years, but the net profit margins, if I see the 2 years, the average growth is coming 11%, whereas the last 5 year, I take the different snapshot. This is very detailed analysis. Yeah, so only 15 basis points, right? Where it's 10 year is 7%. So what I have done in my projection, I have taken the 6.29% of growth, and then I'm just declining the growth by 2%. This is my net profit. I estimate that the year end of 20 is the net profit will be this much. So 3-quarter data I have already available. I just take the estimate the last quarter on the bit conservative side. Okay, so that's pretty much. So based on the this given net profit, I just decline the growth rate. If you're familiar with my other previous video as well, I assume the growth is slightly declining in the future, but given that this is a very conservative approach, and given that maybe because the company might not be successful in doing that, right? They are just in the initial phase, so we have a risk there. But if the company is successful, maybe we need to revisit this after 2 or 4 years, right? So I'm not counting that on the successful part here. So I'm assuming, okay, after 10 years, the company will be just grow as per the economy, and assuming, so that's what my approach is. And if I do that right now, and divide by the number of share outstanding, which is 1430 million or $1.43 billion, I got my share price of $100. And that's from the first model. Let's go to another model, which is the enterprise value model. Sorry about that. It's a lot of data here. I thought just to share rather than just show you the last price. Okay, so this is the number of share outstandings, right? And this is the price. So pretty much you see in the last 10 years, the price is pretty consistent. This is the annual price, like from 34.20, 34.30 and 36, right? If the market cap, how to compute is pretty straightforward. Just multiply the number of shares, a share price by the share outstanding, and you'll get the total market cap. If some investor has a lot of money, for example, this is in almost $197 billion company. How you just add the market cap plus debt and reduce any cash. So the company has a very good amount of cash as per 2019. So this is the enterprise value. One good thing is if the enterprise value over EBITDA score is lower, so anything below than even 15, but this means if you go and buy the whole company, it will take only less than 5 years to get your money back. So which is awesome, right? But if your debt over EBITDA is increasing, so this, but it's also showing the company is also taking the huge amount of debt. As you can see, it was only 11 billion and now is 103 billion dollars in terms of debt. So that's their main problem. They have a huge amount of debt coming, and I hope the bet the company is taking on the EV industry will pay off. And so here again I'm showing those metrics. If I'll take the EBITDA growth, is only 1.93%. On the last 5 year or 10 year, it was 4.8 or 17.45, but I'm just a bit conservative and take 1.293. And this is a current debt on their quarter 3 statement is $88 billion, but they do have $36 billion cash as well, right? So again, I'm projecting the EBITDA and selling by the 3.363 of the EBITDA, right, for the last 10th year of the growth. And again, discount by number of shares. So with this second, I got my price of 1650. So that's this. I'm not using the free cash flow model because the free cash flow was quite coming negative and positive. So I thought just eliminate that by using just the two model, right? Which one was 101 giving this price, another model gives the 6150 price. If we divide both by the equal number of share price, the weight, this is my weighted, and my price of intrinsic value comes as around $80.77, given that all the conservatism I have follow, right? So, and now the price in the market, as we know, is $41. So pretty much the share price in the market is huge discount right now. So that's what at least I believe. Thing is, as you can see, these are the companies like BlackRock, Vanguard, and Berkshire Hathaway. This is right. Berkshire Hathaway increased the number of shares a lot. So the increase in this company is 7%. So you know he is the value investor, the biggest value investor, which all other value investors follow him. So if he's buying, definitely, as you can also reflect by the model, that the company is heavy discount and has a good future growth rate as the company is investing. So might be this is another 10x company, no doubt. Even the companies which doesn't or in the air, as you can see, their PE is going up. I think this stock haven't been picked up by any other market yet, but soon if it get recognized, I think it will start rally. So at least that's what my opinion is. So let me know what you think about it and how you like this video. If you like, please give a like, thumbs up, comment your other favorite stock, and subscribe to the channel. I think that's thank you for watching and happy holidays. Bye for now.